So that is what I've taken into account. Uh, what is the effect of competitive advantage? Well, it is higher sales. And the promoter holding is stable. Reputation of the board of directors and management is decent. Rakesh Jhunjhunwala is an investor in the company, and also I checked the history uh, of the promoter and the CEO. It looks quite decent. I didn't find anything wrong with it. And the ability of the management and history, well, previously they were focused on the real estate, but they have changed their strategy and now they are focusing on the casino business solely, which is a very good sign because they are focusing on their core business, and so far they have been able to grow their revenues in line with what they have promised previously. So let's get back to intrinsic value. So in order to calculate the intrinsic value of a company, we need five things, right? So let's calculate so we have completed the checklist for Delta Corp, and now let's calculate the intrinsic value of Delta Corp. So the first thing we need to analyze is how much cash it will generate. That is called as cash flow. Then we need to decide, second thing is discount rates. How, at what rate will we discount this cash flow to bring it to current present value. Then the third thing is capital expenditure. How much will the company spend to maintain and grow its business? So there is two things. First, you need to spend money to maintain your existing assets, like for Delta Corp it's ship, or for some other company it might be plant, machinery, brand, it can be anything, right? These things are very important to maintain your existing level of sales. This much you have to spend. And the other thing is, to grow your business you need to spend even more than that. So basically, if you're saying you're going to expand your sales, then you need to invest. If it's a toothpaste company, then you need to invest into factories to generate more goods and services. So that is the capital expenditure. What is the forecast period? The fourth thing is, how long, as we discussed earlier, how long will the competitive advantage of the company will last? And the fifth one is the lifetime value of a business. Lifetime value is what will happen to the company after the competitive advantage period is over. Just like in our car example, after 3 years we sold the car for 20,000. So in this case, after 10 years, you have to calculate the lifetime value of a company, because a company is not like a car. Generally companies live longer than 10 years, right? So we need to calculate what will happen, how much cash it will generate after that. So there is a method to that as well. So let's get into intrinsic value. So follow me here and really pay attention, because this is really important. The first thing we need to calculate is cash flow. Cash flow is the amount of cash the company will generate over its lifetime. Now, the formula for that is sales into net profit margin plus depreciation minus capex and minus changes in working capital. I will break down this formula so that you will understand better. Also, you need to estimate the future sales growth to calculate the cash flow.